Welcome to the accounting review exercises for FIN 380 and FIN 600. I'm Dr. Jeff Jones, and in this video I will provide explanations and answers for exercise 1 in the accounting review document. So exercise 1 asks us to match the letter of the correct accounting principle to the descriptions below. And we're asked to choose the principle that best fits the description, and each principle may be used more than once or not at all. And so we're given 8 different accounting principles here. And if you would like a review of these accounting principles, that can be found in Appendix A of the Accounting Review booklet. So let's look at the first item. So Simon prepares a balance sheet listing the current market value of all the items. Which accounting principle is violated? Well, as we know, accounting or financial statements reflect historical cost, so this is clearly a violation of the historical cost principle. Our next item, Sarah received an order from a customer this month. Even though it will take Sarah 3 months to complete the order, she recorded the order by crediting sales revenue in the current month. Which accounting principle is violated? Well, the issue here is basically that revenue cannot be recognized until it is earned. And so in this particular situation, Sarah received funds to complete an order, but she actually did not complete the order. So this is a violation of the revenue recognition principle. The next item, a firm decides to switch back to a LIFO inventory method, then decides to switch back to FIFO the next year. Which accounting principle is violated? Well, one of the underlying assumptions in financial statements is that there is some consistency from one period to the next. And so if you're constantly switching back and forth between inventory methods or depreciation methods or other instances where you have some sort of an estimate, this is clearly a violation of what's called the consistency principle. All right, our next item. As of the year end, a firm is in a lawsuit which they expect to lose and be forced to pay a fine of $1 million. They do not report the lawsuit anywhere in their financial statements. So which accounting principle is violated? Well, this is a situation where you have a potential liability, and even though the liability is not fully recognizable, there is a reasonable and probable likelihood that they will be forced to pay this fine of $1 million. So somewhere in their financial statements, and it could be to the notes, in the notes of the financial statements, this needs to be disclosed. If it's not, it's a violation of what we call the full disclosure principle. Okay, next item. This accounting principle states that the financial transactions of a business should be kept separate from the financial transactions of its owners. And so this really applies in situations where maybe you have a small business or a closely held corporation. Personal funds and business funds should not be commingled, and doing so is basically a violation of what's called the economic entity principle. Okay, next item. Stephen is debating a write-down of an asset's value. If he writes the asset down to an amount that's higher than what is likely to be subsequently realized, which accounting principle is violated? Well, in a situation where you're required to write down an asset, you should always use the principle of conservatism. So if you're going to write down an asset, you should usually provide a conservative estimate of what is going to be realized in the future. And so a violation by choosing a higher value than what may be realized in the future, that's a violation of the conservatism principle. Okay, next item. Evan paid $5,000 for a 3-year insurance policy on June 1st and recorded the entire amount as prepaid insurance. No entry was made at the end of June prior to issuing financial statements in regards to insurance. Which accounting principle does this violate? And we're given an extra note that the firm is not on a cash basis. So they are on an accrual basis accounting system. And so in this situation, basically what's happening is when you're paying for in advance for something that's ultimately going to become an expense, you might record it as a prepaid insurance, but then as the item is used up, in this case, once a portion of the insurance has essentially expired, you need to recognize that as an expense. So not doing so would be a violation of the accrual principle of accounting. Okay, next up, a firm purchased land several years ago. Since that time, the land has appreciated considerably in value, but the firm continues to report that land at the price paid for it. Which accounting principle would support this decision? Well, this is another instance in where the historical cost principle comes into play. And so even though we record an asset when we acquire it, even though it might increase in value in terms of what it could be sold for, we generally do not change the value on the financial statements. Okay, we continue to report that asset at its historical cost. Next item, Terry records revenue earned during the last month of the current fiscal year, but decides to wait until the next fiscal year to record the related expenses. Which accounting principle would this decision violate? Well, this is clearly a violation of what you might call the expense recognition, or what some people call the matching principle. And so in other words, if you're going to recognize revenue from a transaction, you also need to recognize and report all of the expenses associated with that transaction, and that needs to be done in the same accounting period in which the revenue is recognized. So another way of thinking about this is you need to match your expenses to whatever revenue gets reported. Okay, finally, when estimating an expense accrual for financial statement purposes, there is some question as to the reported value of the expense. So Kara decides to choose the highest estimate. Which accounting principle would support her decision? Well, this is a situation, and when we report expenses, the conservatism principle would basically tell us that if we're making some estimate of an expense, we would need to, and it would be appropriate to, record expenses at potentially higher than expected amounts. And so certainly the conservatism principle would support Kara's decision in this case. So that concludes the first video for solutions for exercise 1 in the accounting review document. In the second video, we will take a look at exercise 2, and which deals with account characteristics.